Alright, so let's talk about the accounting equation. Now the accounting equation is the foundation of accounting. And so over here, as you know, I've written down, it's that your assets equal your liabilities plus your equity. And I'll explain it in a second why I've written equity like this. Now, to give you an idea of what an asset is, I've sort of broken it down into two parts, and I'll use personal assets to try to give you an idea of what business assets are, because the two essentially they work the same way. One is just for you personally, and one would be for the business. Now, personal asset would be something like cash. Cash is probably the best asset because it's the most liquid, and I'll explain what liquid is. Also, as a personal asset, you're going to have your home if it's paid off. Another thing could be your car or TV. So assets essentially are resources that you own, and you can think of it as something that has value to it. So in a similar way, businesses also have assets. And again, just as with personal assets, you have cash. Cash is king, right? So every business works on cash. Cash is the best asset that you have. A business is also going to have other things like equipment. And this equipment, depending on the type of business that it is, could be different things. So for example, probably almost any business nowadays is going to have computers. So computers are equipment, they're resources that you own that have value. If you're a manufacturing company, you're going to have machinery. So machinery again is a resource that you own, it has value. And there's a lot more. There's buildings, which I'll just abbreviate like this. Buildings are assets as well, again, because the resources you own have value. Another thing, which actually you usually put it right under cash, but I waited till the end just so that I could explain it a little bit further. It's accounts receivable. And for accounts receivable, I'm just going to abbreviate it like this, A/R. Again, just keep in mind it stands for accounts receivable. And accounts receivable, they're future resources that you're going to get. For example, let's just say you have a lemonade stand on the corner. That's your business. And you give someone a cup of lemonade, and they say, I'm going to pay you back tomorrow. So you gave them the cup of lemonade, meaning you had the transaction was complete, except they didn't give you the money. So even though they didn't give you the money, that money in essence is a future resource that you're going to receive sometime in the near future. So you also count that as an asset. It's an account receivable, and again, it's something of value. It's a resource that you're going to receive in the near future. Now let's talk about liabilities. So personal liability is going to be something like your electricity bill. Usually you pay it every month, and it's something that you owe to the utility company. Another liability could be your mortgage payment. If you haven't paid off your house, it's a liability you own to the bank. Another could be your car payment. Again, just another note that you have to pay to the bank if you haven't paid off your car. In the same way, businesses have liabilities as well. So a business liability would be, just like a home, they would also have an electricity bill. So they also have utilities. So usually, you have more, so generally, we call these utilities. And if a business also takes a loan from the bank, usually for taking a loan, you're going to have interest payments. And periodic interest payments are going to be interest payables or interest liability. And this is again considered an asset as well. It's considered a liability as well. And there's really just there's a lot of other things. Let's just include salary as well. Salary for your employees. Yeah, you owe that to them, and that's a liability. Now, equity. So equity, if you want to think of it in terms of a business, it's the worth of the business, the value of the business. And equity essentially is assets minus your liabilities. Now, within equity, you're going to have 4 different groups, and that's why I've broken it up with these brackets around equity like this. The first is your owner investment, and that's any money that the owner puts into the business, and that adds to equity. And so I'll just put a plus sign over here. Sorry, it's kind of squeezed in right near the bracket here. And then you also have your withdrawals, and withdrawals are any money that the owner takes out of the business. And so you're going to subtract those. That's why I have a subtraction sign right before withdrawals. And you're also going to have revenue. So I'm going to add revenue, and revenue are usually money that you receive in the normal course of the business. So if you are a law firm, for example, when you provide advice to a client, they pay you, and you're going to take that in as revenue. Or if you're a product company, when you sell your product, when there's that exchange that's made, you're going to take that in as revenue when you get the money for that. And last but not least, you're going to have your expenses. And you're going to subtract expenses because expenses decrease your equity. And expenses are just, again, in the normal course of business, money that you have to pay out, usually for different things like salary and bills and interest payables. And in subsequent videos, I'll show you the relationship between these liabilities and expenses. Now, to give you a really quick example of equity at a personal level, think about if you own a home. If the total value of the home, again, I just said asset value because a home is also an asset. If the total value of the home is $100,000 and the amount that you still have left to pay is $70,000, that means that the total equity in your home right now is the $100,000 minus the 70, which is 30. Simple enough. And that's how equity works essentially. It's just your assets minus your liabilities. And again, I use this example because I figured it's pretty simple enough. But that in a nutshell is how equity works. I've also included an abbreviated version of the accounting equation right here. So again, just keep in mind assets equals your liabilities plus your equity. Now, it's always going to work like this. Assets always have to equal liabilities plus equity, and that's also why we have this system in accounting which is called double entry, where your debits have to equal your credits. If this sounds a little bit confusing right now, don't worry. I'm going to explain this in subsequent videos. So whatever you do to one side, you also have to do to the other. That's the only way that assets are always going to equal your liabilities plus your equity.